watching Talking Point, and we're speaking right now with Samir Arora, founder and fund manager of Helios Capital Singapore, even as we continue our non-stop coverage on the union budget and its implications right here on NDTV Profit. Very good morning, Samir. Great to speak with you. I've been following everything that you've been tweeting, and in the run-up to the budget, you were very, very vocal about how there should not be any regulatory squeeze or any messaging to really shrink the volumes or burst the bubble, so to speak, of derivative volumes. I'm curious to know what you think about what was announced yesterday and how much impact it will have.
No, I'm sorry, but I didn't say that. I was always saying that you have to burst the bubble of derivatives volume. In fact, I was saying it for maybe 6-8 months that the futures and options trading volume is too much. So I was talking only that you should not do anything on taxes, basically long-term capital gains and short-term capital gains tax, because I am in India in two roles, one as the promoter of a mutual fund, but also as an FII, and who has the number one longest track record out of 1.4 billion people, because most others have retired and I refuse to. And I was saying that on a post-tax basis, India will become less attractive. India has done well on a pre-tax index level. If you look at just index level performance of India versus other countries, but if you put a 15% tax average, let's say whatever, some number, and then you compound with that every year, that's every year you're paying some long-term, some short-term, and make whatever assumptions you want to make, that then it will not look as well. It might still look better than many countries, but then it will depend on phases, because last 5 years India has done well, China has done badly, this, that. But over time, your attraction by definition has to come down a little. The most amazing thing I found yesterday was that people were talking about earnings changes of 1%, and that in an IT company, the bottom of the range has gone up by 0.5%, and therefore that will change EPS by 2%. And therefore, people write research reports of 20 pages of this. But when you hit the earnings of the investor, which is the end result of all that research you were doing, by 4-5%, they say it doesn't matter.
Do you think that's what's happened?
0.1% change in earnings matters.
Do you think that's what's happened, Samir? That because of the changes in long-term and short-term capital gains tax, that earnings of investors have been and will be hit?
No, I won't even mean, do you think? It is just simple. Let's say your earnings were 100 before, and today, and you were paying some combination of long-term and short-term, let's say 50-50, just you can make it less more. So you were paying 10 plus 15 divided by 2, 12.5% tax, and then you were paying 2% surcharge. So your earnings were 85.5, 14.5 tax. Now you do 12.5 plus 20 divided by 2, whatever you want to change that combo a little bit, and then you add 2% surcharge. So your earnings are 82. So it's not the end of the world, but 82 divided by 85.5 is some 5%. So if somebody comes on TV as a professional, as an analyst, as a strategist and says, this is worth 5-6%, that is all. What I get upset with, and unnecessarily even on my holidays, that the guys come and say this is irrelevant. No, it is 5%. And this is more 5% direct than 20 basis point change in the earnings growth from 4% to 4.2%, for which the same brokers will write maybe 20-page report and do 5 conference calls, and they say our EPS has gone up by X%, which, by the way, has happened for 1 or 2 years. Means when you do these earnings upgrade, downgrade, nobody knows what will happen in year 4 and year 5 and year 6, because that was not even in discussion. You are talking, oh, there are more marriages this quarter instead of next quarter, therefore those earnings have been preponed, so the stock goes up 10%. But when you have a permanent hit, at least say this much. It's not going to change anybody's story. We are bullish on India. That is our business and our job and our life. But to say it doesn't matter just makes me feel that everything else about them is not trustworthy when they come and talk like that, and which is what makes me upset, even though they are my colleagues and some of them are my friends.
Samir, for every investor conference that you and I visit together, we will have this conversation with the sell-side head of that brokerage house about why is it...
There is not one brokerage, there are many. But
I know. Yeah. But Samir, so let me phrase my question this way. One of the beliefs was that the budget doesn't need to do anything uh, counter fruitful to the equity story, because we are supposedly stretched on the
that is
valuations,
not right.
etc.
A little bit.
Now that this has happened, does it cap near-term upsides until earnings prove their mettle?
I agree with that up to a point, because what happened was that if you see the run up to the not budget, but generally for the last few years, some sectors had done very, very well and disproportionately well compared to the market. Let's say the infra type or the PSUs or the defense or rail, but they were not like normal outperformance of 5%, 10%, but two times and three times the market or whatever. And they needed these stories more. They needed the budget to be aggressively focusing on those areas. So for them, I think there'll be a big sector rotation. But the budget was otherwise very, very good according to me. For example, to have the deficit target at 4.9% according to me means that obviously it's very good in a macroeconomic sense. Maybe there'll be an India earnings upgrade. The interest cost and all will come down. I think the financial sector will be a big beneficiary. But the sectors that were doing well needed that thing. Yeah, I don't think that the whole market or the IT guys or the financial guys needed particularly great specific targets from the targeted this thing from the budget. And but the sectors that were high flying definitely needed, and I don't think they got that. So there'll be that rotation for sure. Which anyway they needed a people needed to move away because the expectations built in were so high, which makes it made it visibly obscene.
So one is the capex theme. Is that something you're referring to, because that number has been unchanged, or is it the PSU space
No,
or
it's
some of the others?
unchanged. It's unchanged. But you see, if you see year-on-year growth, if the year-on-year growth in these numbers is 5-10%, that is normal inflation-related growth and GDP-related growth, like that 11 lakh crore or whatever these numbers. So those numbers are unchanged, but the market is not unchanged, no?
But Samir, only 8 months left in the year. You think you don't think that's okay? 11 lakh crore for 8 months of allocation.
No, I'm not interested. I don't care about the 11 lakh crore. I'm caring that from a stock market point of view,
There
if
should
your
have been
stocks are
okay.
up 400-500% more
Yeah.
than this thing than the market, then your story, your dreams, your expectations have to be constantly on the move up. So, for example, if many stocks in India are up more than Nvidia is up in the last 2 years at least, not maybe 15 years. But in Nvidia today also looks as low P as it was 2 years ago. Our Indian guys, do they look like that? Some of them, not at all.
Yeah, I suppose, especially on rail, defense, and those kind of plays, because a lot of the rail budget has gone towards Kavach and security, as it should. But a point noted. Are you buying this consumption story, Samir? That the employment moves will now boost consumption, and you'll have a better run in staples, etc. Are you buying that story?
No, I don't buy those stories because I don't buy well-penetrated stories. Because what happens is when you are in a well-penetrated sector, then you are relying on India's growth and these very, very macroeconomic reasons that in the long run employment will go up and all that. It's better to buy things where there is some under penetration, or basically in simpler terms, because the multiples of this sector are very high. I am not interested in stocks which grow instead of 5% volume, 3% volume, which is lower than India's GDP growth in dollar terms, which is say 6-7, and therefore your revenue will grow 8-9%. I'm not interested. At least then you should try and grow 20 odd percent in earnings, or 25% if possible. So the consumer we buy, which we call consumer, are these Zomatos and the Varun beverages and stuff like that, which at least we feel will grow high. But I'm not interested in a company which used to grow at 6 saying I'll grow at 8, that the market gets excited that this is an earnings upgrade. For me, even that new number is not a good number, so I don't buy those kind of companies.
So what is Samir Arora looking at right now? A budget, of course, is one event, quarterly results is the other, and in a market which is going to see some rotation, what are you looking at right now?
That is the correct word you used. That is our business model. And we keep saying it to everybody that you are not supposed to define for 20 years what you will buy and for 5 years what you'll buy. You buy 40 companies or 35 companies from which around 6, 8 companies will change every year because something would have changed. Sometimes the budget would have changed, sometimes the focus would have changed, sometimes market preference would have changed, sometimes earnings would have come and the stocks would have become very high. So you change 6, 8 stocks on the margin, and you are then ready for the next 1 year, 2 year, 3 year period. So we say the long term is a series of 1 to 3 years. In that context, we have already sold some of these infra type, defense type, railway type, and you change a few stocks. Now that we have to figure out which we will do peacefully, whether you buy one more IT or two more IT stocks or one more finance stock or some other stock. You change 6 stocks, which you will know because mostly the research guys are common. So plus minus, you'll see that in our mutual fund after 1, 2 months. But broadly, you need to change 6 stocks. Therefore, every day to say this is a 100-year story, that is a 40-year story, I don't believe that. I need rotation of 10, 15% is required.
Yeah.
And the rest of the stocks anyway continue, not necessarily for 20 years, but they may continue for 5 years, like many
Okay.
have.
No,
That's the model.
that's fair. I'm just wondering where you were on the whole IT cycle. They were least loved for the longest
Yes.
time, have
And
changed, have been back in favor. I was wondering where you've been or
no,
how
we
you
are
felt
not.
about this.
No, so we are not fully weighted also because we were underweight for 2.5 years. For 2 years, we were zero from June of 22. So now we have basically one stock we always had, and we bought 1.5. So we are still underweight. That's what I was saying on the margin. Because we do elimination investing. We don't think that anybody knows what to buy. We just know what not to buy or what to trim and all that. So in that, it is now in one of the potential things for this rotation, which we will see. But so far, we are not overweight or even market weight in IT
Not overweight or not even market weight in IT.
as of now.
As of now, yeah. Samir, does the FII versus the promoter of the mutual fund in India think differently about what happens post-budget over the course of the next 9 to say 7 odd quarters?
No, that I don't know. But as a fund manager, since I am primarily and actually totally responsible only for the offshore long short fund, my trades and my views are more whether to reduce my net and what to do. And the mutual fund guys are trying to beat a long only index. So they have a different objective. And they might change one stock here, one stock there. I am much more aggressive than them.
What is the aggressive long short managing Samir Arora thinking about right now in terms of changing the portfolio stance, if at all?
So that I have already done in the sense that my net exposure, that is a long minus short, on around June, going into the elections and even after that, was 75%. Now
Okay.
it is below 60%.
Sorry, Samir, can you explain? I mean, just so
Which means
are you a lot more
that
defensive?
no, that means I have shorted and I have reduced some of the longs on these extra, as I was telling you, these infra type, whatever, not infra, but capex infra, whatever you call it. Those I had reduced, not now, that I had reduced before.
Right.
Because I said it on TV also that the expectations were too wild. The expectations were too wild, and even a good budget could have not helped them beyond a point. Maybe then they would have extended by a few days, maybe a few weeks. My problem sometimes is that I am very fast, rightly or wrongly, in analyzing, and sometimes I'm right, but I'm early. And sometimes I'm wrong also. It's both ways. But I'm saying I just do everything fast because that is the way I talk, that's the way I act, that's the way I react, that's the way I am.
Okay. And so, no, which is fair. I mean, as long as it's yielding results and your performance speaks over the number of years. But Samir, the same argument of these extended valuations can be made for maybe some defense names, the shipbuilding, etc. as well, or not quite? Stretched valuations.
I am talking about those names only.
Okay, only. Okay, fine.
Samir, are you completely done with the PSU story? Because this disinvestment hopes
PSU
are...
financials.
Yeah, PSU financials you still like?
We have, yes, both.
Okay.
State Bank, Canara Bank.
Okay. And in financials overall, do you think financials
I still like the
way?
financials the most because financials at the end of the day, they are able to connect themselves to whatever good is happening in the economy. Sometimes it's the consumer growth. Sometimes it's the this thing growth. Sometimes cost reduction. Now for HDFC Bank, it is balance sheet improvement. Whatever, they are able to do that, and generally they have a good history. And generally, and I think even this year, their growth will be higher than every other segment of the market, and many of the other segments would not even grow at half their rate. For example, the I guess big picture, the financial guys will grow their earnings still maybe 15-16%. Even HDFC Bank will grow maybe 13-15%. And I don't think a single IT guy will grow that much. Or if they grow, they will be considered as the biggest heroes that this market has produced. And the consumer guys will never easily grow like that. The big staple guys, I mean. So therefore, and they have not done well for 2-3 years, but they have done well for us and for the market for the last 25 years. So otherwise, people don't think that these are some unknown fellows and we are betting or they will bet on some shady unknown names. They have gone through this relative underperformance, and that also driven mostly by the performance of the big 3-4 companies, which is HDFC Bank, Kotak Bank, Bajaj Finance types. But the rest of them actually have also done well. So therefore, we always like and continue to like and continue to justify to ourselves our overweight in financials.
Okay, so financials is overweight. I wondered if you have a view on real estate after this removal of indexation. I think people are still trying to figure out.
No, that
what it does.
actually, I don't think it. We don't have, by the way, even one real estate company right now.
Oh.
But I don't think it is bad for real. We had it, but we sold it about a month, 2 months ago because it was just too much. Everything has, and actually the stock, the big one hasn't gone up for the last 2-3 months anyway because it just we can see it. There is too much. Something has to give up, and every time you announce a project and then you sell X thousands of crores, then next quarter you're supposed to sell 2X thousands of crores. How can it go on? We also know broadly how many people are there. And even yesterday, by the way, I saw one interview. Maybe they came on your channel. I saw on, I think, another channel, basically saying that I am now hoping that investors will come back into real estate. Excuse me.
I
We
see
always
reverse.
thought all our life
Yeah.
we always thought all our life that end consumers are supposed to come into real estate, and when investors come, it is going to end in a problem, as it has always ended for the last 5,000 years. So you don't want investors. Even I don't think the government wants investors in real estate, because one of the objectives must be to lower real estate prices so that people can afford. For example, in Singapore, if a foreigner now buys real estate, there's a 60% tax, which used to be zero maybe 10 years ago. So the idea was to make real estate prices low, for to somebody to feel proud that now investors will come into this sector, means that there's nothing much. But I think otherwise, I don't think it is bad for the sector. It is bad for the old properties where some trade-off will be there, whether this scheme is better, that is better. But what is it? That is history. Those guys can make less or more. It doesn't change the dynamics for the new guys. From the new guys' point of view, the tax might be better off only, I think.
So okay, so real estate was never something.
But what I'm saying is, you can't make that story that we will now get speculators into our market. I mean, how can that be a presentable story? But people talk different things when.
Okay, so the one big idea, Samir, and while we let you go, and always fascinating chatting with you, the one big idea, the one big trigger that now that the markets will look like, elections are done, budget is done, Q1 earnings, of course, we'll have to wait and see what the full picture looks like. What's next?
No, actually, I don't think that every day you need a trigger. You basically need that the earnings should come through and your valuation should not be so high that those earnings growth gets wasted. Let's say, for example, Bajaj Finance last 2-3 years, their earnings grew. But because at that time the valuations were high or whatever, maybe hindsight, maybe that time, right or wrong, somebody may have thought, but you did not get that in your stock market returns or in your stock gains. So that is the issue with all these sectors and all. Many of them will grow and many of them will grow less. You want that you should not waste that earnings growth by having valuations which are very high. Therefore, I am not saying, and I don't think anybody is saying that this market is very cheap or that, but I don't think it is expensive. It is that a plus minus the earnings growth you will get. But since that earnings growth was 10-12%, and then you put in a tax which makes India relatively unattractive, you lose, according to me, 4-5% for that. Now, whether you actually lose it or that also we hype because our mutual fund guys are getting money, it's a different game. But please, one thing I should say, big picture. let us not think that there is only one country in the world. I only invest in one country. That is my job. And for 30 years, I've been doing it. But realistically, please understand that there is not only one country. Just yesterday night, not even day before yesterday night, Google, which is a $2.2 trillion market cap company, which means 45 or 50% of India's market cap, grew its revenue 14% and its profit, I think, 28%. So in theory, a global investor could, instead of putting money here, could put, because they put 2%, they could put 1% more in Google, they will get higher growth as of today. And they've been, that higher growth has been there for long. They will always be able to find 20 companies. So I'm saying big picture, let us make India at least tax neutral, ease of accessing neutral, then everything else is in our favor, and we are the biggest beneficiaries if the market does well because of this thing. But on the margin, in the short term, for the next 2 months, or 1 month, I have reduced my net. So I'm telling you that today. Otherwise, it looked like all these other guys were talking about 20-year stories, which is true. It's a different story, but there are 20-year stocks in the world also.
20 years is a different story. Thank you so much, Samir
Yes.
Arora. Always fascinating
Thank you.
chatting with you, founder and fund manager of Helios Capital, on the budget and how he sees things panning out. So all the time we have. We'll take a very short break, but stay tuned. A lot more on the other side.